Hi there, Casey Healey. Back in, I was going to say the office, but we're not. We're on Zoom today with Nick Ball from Inovayt Finance. Thanks, Nick, for joining us on our investor update on what's happening in finance and what are we seeing. Obviously, we're in lockdown at the moment, so Zoom's our go-to to get this video shot and to keep the education there for our investors. What's happening in the market, Nick, or in the lending space?
To be honest, not much has changed in the last 4 weeks, or however long it's been now. Everything's still, firing along. Banks are actually really quick, which has been amazing. Rates are still incredibly low, and there's still a lot of activity. Like, despite the fact that, obviously property listings are very low, there's still a lot of activity. There's still a lot of activity floating around, and I think, mortgage lending levels are at all-time highs. So, there's plenty happening.
That's awesome. How have you seen, has COVID kind of taken effect? Is there many people using, pausing their home loan at this stage in this kind of lockdown time?
Yeah, we had a bit of a chat about this week, and our team is, right across the eastern seaboard pretty much. And we haven't seen any, to be honest, this time around. Last year we saw a lot more. I think, so far so good. I think Melbourne probably will see a bit more in the next 1 to 2 months if it continues to go. Like, there's a little bit, from what everyone's saying down there, there's a bit of uncertainty down there. But I haven't seen too much yet. But time will tell as to what happens in the next month or so.
Definitely. We even from like a tenant's perspective, we haven't seen it, the hardship there like we did 12 months ago when we went into lockdown. So that, I guess, is a positive to take from this. The property market, it hasn't stopped. From a lending point of view, do you see any issues or concerns in the next 12 to 18 months because of this, can I say boom, or?
Yeah, absolutely, you can.
Continually hasn't stopped.
It's definitely a boom. Look, I think what we have been speaking about lately, and there is a little bit of media around it, is similar to what we saw back in 2015, 2016. Investor levels are starting to come back. That's being noticed. And obviously, the market increases are pretty astronomical compared to what we've ever seen before. So what we saw, and I always like to say, we've generally seen something similar happen in the past. So last time we saw this sort of stuff.
It's always a trend. There's cycles. There's cycles in the property game, and you've just got to watch for the cycles. And the point is, sorry, just interrupted you.
No, exactly right. No, it's a great point. People should always look at what's happened in the past. So what we saw happen back in 2016 and 2017, and some investors may remember this, it scarred many, is that all of a sudden the banking regulators decided we've got to put a bit of a slowdown on this market. The best way we can do that is put a slowdown on investors. So what we saw come in was a cap on investment lending as a portion of banks' loan books, and also a cap on interest-only lending as a portion of banks' loan books. And what that did basically was set new rules for the banks, and the banks take that stuff very literally when it comes from regulators. So they changed the way they did business with investors pretty much overnight, and that lasted 12 to 18 months. And I think, if you look back, and there's been a little bit of, a lot of graphs and stuff go out in the last 6 to 12 months, you can see that 2018 was one of the years where we saw actual backwards trends in a lot of capital city growth rates. So it's, it can have a dramatic effect on the market. However, I guess what we're seeing now is that we've got COVID as well. So the banks and the regulators are a little bit apprehensive to do anything dramatic. But we are thinking that, in the next 12 to 18, 24 months, they're probably going to have to do something to throw the ice on the fire, because it can't keep running like it is.
No one's going to be able to afford anything.
No, and that's the thing. Like, as they sort of have to be a bit protectionary as well. Like, one of the things that a lot of banks and the regulators are keeping a close eye on is a ratio called DTI, which is debt to income ratio. So obviously, because rates are so low, the assessment rate that banks assess your ability to borrow at is so low, your borrowing capacity has never been higher. So how can they manage that? They're looking at, okay, well, what's this family group's income divided by the debt that they've got, And the rough guide is that they don't really want to see over a 7.
Yeah.
So that's probably also something that will get focused on, has been focused on the last 3 months is, we're seeing banks allowing up to 8, whereas they're now starting to be a bit harsher on that score.
And that would also allow for allowances, like a movement in the interest rates and what they're covering there. So obviously we think interest rates, they can't come down anymore. So they've got to turn at some stage.
Exactly. And we've the long-term fixed rates are now back out to, 2.5% sort of thing for the 4 and 5 years for the owner occupieds. Variable rates are continuing to come down, which always happens eventually. But that assessment rate hasn't moved. It's sitting now about between 5 and 5.5%, depending on the bank.
Yeah.
So I guess that is their safety net, is that we're unlikely to see an increase of the actual rate up to that 5% for a pretty long time. But they still want to be careful. You never know what's around the corner.
Yeah. So although our interest rates are sitting at that 2.5, the bank are actually assessing loans at 5% affordability to ensure they've got that net, that safety.
Yeah, exactly right. And to give you some context, it was only 12, 18 months ago that nearly every bank was at 7.25% assessment rate. So, we've come a long way in the last 18 months. And, there's always a stress test involved.
Definitely. Current rates available in the market. So we're still sitting at that 2.5%.
Yeah. In terms of from an investor's point of view, fixed rates incredibly low.
Yep.
Have been, for some time. P&I rates, low 2s, interest only, mid 2s, depending on, what sort of loan to valuation ratio there is. There's some pretty incredible figures out there. It just depends on your circumstances, I guess. Interest only rates, quite low. So I guess the conversation that a lot of us are having out there with investors is now's probably the best time to restructure.
Mm-hmm.
One, you're going to get the best valuation.
Yes.
That you've probably had for a while, so that you can restructure and structure it the way you want to. And 2, the rates are there. You're seeing investors lock in 5-year interest only rates at high 2s. So that for the next 5 years you're paying 2.99 or whatever it is. Your rental yield's going to be where it's going to be. You're just locking in that surety for another 5 years. If you're not going to be selling those properties, then you're mad not to, really. And you've got banks out there that want to throw you $3,000 just to refinance to them. So there's a lot of that happening in the market, and I think that'll continue to happen over the next 6 months.
And if someone wants to refinance and wants to have a chat to you, how's the best way for them to go about that?
Give me a call, shoot me an email. My details will be at the bottom of this, but absolutely, just reach out and we can have a look at everything and work out what can be done.
So you have to not have a current fixed rate. So if you are currently under fixed rates, you can't look at refinancing, or
you can, but there may be break cost to exit that. So it depends. We do a cost benefit. What's the cost to get out of that rate? Generally, when you've got a fixed rate, when there's a break cost is when your rate's higher than where the market is now, because that's where the bank stands to lose.
Yes.
So that's, it may be that it's worthwhile. It may not be.
Depending,
and it's always worth.
Rate, I guess it's fixed at to.
Exactly right. And it's always worth, if you're someone in a position like that, just give your bank a call and say, look, this rate's pretty high. How much would it cost me to get out of it?
And that's if you want to have a chat, might sharpen their pencil a little.
They may say, well, if you stay with us, we'll break it for free and you can fix to this.
Yeah.
Because from a bank's point of view, it's cheaper for them to retain a customer than to bring on a new one. So often we find they're willing to come to the party on a lot of, things that they may not have said previously. So it's just about asking the questions.
Perfect. Some great tips there for investors. And we do say, have a look at your home loan. Like that's your biggest expense on your property. So if you can save a couple of dollars here and there, like it's all going to add up, and especially over a term of a loan, which is anywhere from 20 plus years to 30 years these days. So definitely worth looking at. Thanks heaps for your time today, Nick. I really appreciate it. As always, great advice for our investors. as Nick said, Nick's details will be in the below comments. Give him a call, send him an email, reach out to me and I'll put you in touch. But we want to help you maximize your return on your investment. And the best way to do that is definitely to do your research and look at your investment loan and your rates and make informed decisions.
Awesome. Thanks, Casey.
Thanks for your time, Nick. Maybe next time we might be in person again.
Who knows? Who knows?
Let's hope, hey? All right. Thank you. I'll talk to you soon.